Hello and welcome to the Investing Master Series. My name is James Boyd. Today's date, June 30th. Tomorrow's July. Um, if you've been watering your yard, you know that it's been a battle. So, all right, we welcome everyone here today. We've got with us Olga, Crispy, David, Ricebird, Grace, and many others. Tell us where you're from and hello back to you. We also got with us the Barbara Armstrong. Say hello, Barbara. And just real quick, as we get started here today, let's go ahead and hop right in. Now, remember, this session is live, but it's also being recorded. I'll share with you the YouTube where we actually broadcast these actually from, and I'll also share with you our X page as well. My handle is at James Boyd CS. Barbara will post hers in the chat. That way you can just click on it and follow her as well. We do post educational examples and announcements there daily. Now, just real quick as we get started, remember that we'll talk about stocks and options. If we bring up options, understand that options carry a high level of risk, not suitable for all investors. When we talk about the information, it's done for general informational purposes only. And also understand that they're not meant for individualized recommendations. They're examples. Also, when we talk about our examples, we will do those examples in the Paid Money software application. Remember that investing involves risk, including loss of principal. It could also be unrealized gains, like on the long call example of Johnson & Johnson we'll pull up, okay? Anyway, maybe not surprising. Also, we'll talk about short options. Think of that as, let's say, cash secured puts, probably the most of what we would be thinking there. But understand that if we did like a covered call, that could be a sign prior to expiration. If we sell the put, that could be a sign, which means we're the buyer of the shares prior to the expiration. If they're American style options, they can be assigned prior to expiration. Understand what that means and if you are okay with that. Now, in our examples, we'll talk about the kind of the market conditions. This is the last day of the quarter. Kind of talk about some of the movement. We've got some questions actually in the chat regarding the tech space, kind of some of the price movement there, wider bid-ask spreads. We'll talk about that. We'll bring that up, and that's been an interesting area. Yesterday, we actually talked about looking for stocks that come down to the middle of the previous day's range, whether it's a green or a red candle. Now, we'll talk about some examples of that as a follow-through of what we talked about yesterday. So let's go ahead and actually just hop right in. Now, first off, what I'm going to do is let's go right back to this chart. Let's pull up real quick SPX, not PSX. But if I actually look at, let's say, the SPX, we said yesterday it kind of looked like more of the S&P 500 was kind of a little bit more neutral. Today, we're kind of holding back in the range. Now, here's what we've got to understand is sometimes neutrality or range-bound price action, it's not necessarily bad. Why? Well, because it's building a support level. Why is that important? No, you want to know that actually that as the prices go up, that there's support levels building and that buyers feel comfortable to actually buy in that range-bound price action and build positions. It's also important because when we actually see the SPX actually sitting in the range-bound action, that the volatility, the VIX, okay, well, that it's not, let's say, spiking price action. Yes, the VIX, like the market, can be range bound, but this is kind of nice to kind of see that when we do have spikes in the VIX, they don't last very long. And if they, number one, they don't last very long, and then two, they don't go up very high. And if they don't go up very high, it probably tells us we're in what type of market? A bullish market. A bullish market does not mean that everything is going up, okay? Just look at the Japanese yen. The biggest actually thing is it probably means the majority of stocks are actually going up. Now, the one thing we've got to understand is when we also take a look at the NASDAQ, there were some questions on that, so let's hit this. The NASDAQ is kind of looking a little bit more like the S&P 500. Now, that would be welcome, okay? NASDAQ, when we had software actually going down, cloud going down, really getting pushed down aggressively, okay? Now we're kind of seeing the NASDAQ, S&P like, neutral, okay? The SOX, let's pull this up, okay? The semis, we talked about that diagonal support, and it kind of looks like we're getting a little bounce here, okay? And if you look at it, let's say, well, what about the Dow Jones? Okay, well, the Dow Jones, if we were to close here, this would be the highest close. Okay, highest close we've actually had. Okay, and if we look at, let's say, the small caps, Well, if we were to close here, this could be the highest close we've ever had if we close here. Now, what about the mid caps? As far as this morning, they were also at the high as well. All right. Now, so it kind of looks like the Nasdaq and the S&P, kind of summarize it, kind of neutral price action. Now, remember, if you get neutral price action, that means something's going up, something's going down to create the offset. What does that tell us? Go look for the things that are going up. That's what it tells us. If we looked at large caps, there's more of the uptrend. If we looked at the small caps, there's more of the uptrend. And the biggest actually thing is, why don't we talk about, let's say, the small caps? Out of the 2,000 stocks, I counted only about 37 that actually really have higher volume and the price maybe in the range. So we don't typically talk about buying small caps individual stocks. We talk about the example of buying something that tracks the index of the Russell. Okay. Now let's kind of talk about just real quick. So we already brought up, let's say, the semiconductors. We also need to actually bring up, let's say, the IXT. The IXT kind of looks like it's forming maybe a symmetrical triangle-ish. Okay. Definitely basing. On the bottom side, the MACD is not going down as low. We've hit that a bunch. You don't go down as low as you did before. You're building up momentum to do what? That's called breaking the horizontal resistance if it's basing, or if it's downward sloping, it could be starting to break diagonal resistance. Now, we said yesterday, keep an eye on the cybersecurity industry group. Okay, think CrowdStrike, think Fortinet, FTNT, CRWD, and the industry group, of course. And the biggest also thing is with this, if we see that MACD get shallower and shallower, we are almost gone green. The chances of breaking that diagonal line are becoming pretty high. Now, if we also come to these other industry groups, now, by the way, when I say technology, also keep an eye on software, which has done better. Okay. I can't say it's upward trending. And then cloud, at least a bounce back. Okay. Those are not upward trending, but they're trying to bounce back. And obviously, when we actually look at industrials, you're going to see that those are kind of marching away to the upside. Could it continue? Now, the name of Caterpillar we've talked about at length. Okay. Now, here's the deal. If every day you're coming up with new stocks, that means you're probably not riding trends. Okay. Because what happens is you find the main vein of the ones that are actually trending. And in trends, there's highs and higher lows. Just because we have a red candle here, there, and there, and how long did those last? One day. What does that tell us? Now, it was one day red candle and then green. And for the love of Pete, please tell me what I want to hear. If you go down less than 3 days, meaning red candles, there is an upward trend on the chart. Okay? And here's the deal. A lot of times, and I've been there too, you see a red candle and you get scared. But remember, you get a red candle, 2 red candle, 3 red candle, as long as it's not getting down below support, the stock is exhaling and in the process of trying to make the higher low. Now that Caterpillar position, I'm not going to speak to this because we hit this yesterday, but if you look at Kitty Cat, you're now going to see the stock position, just 10 shares, pretty much tacked on 378 here today. Remember, to get the bigger trends, what did I say? You got to ride the higher lows. Oh, I know it's horrible in the short term because you actually got to give some of that unrealized profit back. But if the investor's trying to get the bigger profits, got to ride the higher lows out. Okay. Now, what you're now going to see is if you take a look at this, those shares were purchased, 2 weeks ago? 1334. 1334. If we actually took out that position in this account, took it out, that account was about 52,300. This one position in like the last 2 weeks moved this portfolio, that 110 shares. Don't ever laugh again at the 10 shares, okay? 2.5% on that one position. All the other positions, let's say it doesn't even matter, okay? Some up, some down, they offset. That 110 shares. So you got to remember something is when we buy these bigger dollar stocks, $937 less shares, but you got to remember it's moving more point-wise. Remember that. Okay, now, the other one we're going to kind of keep an eye on is we know Apple actually got pressed down when they actually said they raised the prices. I said last week is that most people that buy Apple don't buy it based on the price. If they were buying based on the price, they'd buy a Google Pixel phone or a Samsung, and so on and so on and so on, or some other type of brand. If people are usually buying Apple, they're usually okay with it. What we don't understand is a lot of people are not paying the phone off or the iPad off or the computer off all at once. They might be doing installments that through some of the programs could be 0% interest, okay, potentially, or through AT&T, Verizon, and so on, T-Mobile, okay, through their phone. That bill is, the cost is actually built into their plan. So the thing we want to kind of remember is sometimes investors get it wrong. Trade number one that we're going to do here today is along that main vein. Did investors over-focus on, prices actually up, therefore consumption down? Now, I don't know about you. I mean, let me ask you a question. In your area, do people spend a lot of time on their phone? Do they spend a lot of time on their iPad, their computer? Do you have to pry it out of their hands and say, honey, could be him or her, okay, time to go to bed? Or your kids, okay? Now, here's the thing, what I'm kind of noticing on this as well. Now, you're going to notice that actually 2 days ago, what type of candle was that I'm pointing to right there? What type of candle is that? Now, Barb teaches us in Getting Started with Technical Analysis, so please make her feel like what the effort that she put in was well worth it. Go ahead. Let's actually help Barb out here. Yeah, that's called a piercing line. Could anyone actually tell me what today's candlestick is so far? That is correct. Okay, it's a bullish harami. Wrong answer. Okay, that's a bullish engulfing. Now, the biggest also thing when we come back to this, what's the area, shorter term area of resistance on the chart? Well, the short-term area of resistance is where we gap down to. You'll see that we actually fell down from there to there. And what you're now going to notice is when you gap down, the open of the red candles becomes the area of resistance. Now, the thing is sometimes is if that resistance breaks, all those investors that said, look, just tap me out, I'm just going to throw in the towel. All of a sudden, those investors that tapped out and said, nope, higher prices, therefore they're not going to buy. But sometimes people make emotional decisions. Fair, okay? And they do it with retail, but they also do it with investing too. And so if all of a sudden we start to get above resistance, and if people are buying below resistance, you got to ask yourself a pertinent question. Why are they buying below resistance? Well, maybe they don't think it's actually going to stay down there. Maybe the short-sightedness is too short. So what we're going to do here is we're going to start to actually build a position. So when I say build a position, we're talking about if we said we're going to normally invest $10,000, maybe we're going to buy $2,500. Maybe we're going to buy $5,000. Stop thinking, if you do, that every position you got to go all or none. Tippy toe in. It's like going into the pool. You don't typically just jump in the deep end. You get in, you kind of see if the water's warm, and so on and so on and so on. Same idea. Now, trade number one here. We're going to go actually to Apple. And let's say example given, now we've been working a little bit on that margin account. Let's swing over and give some love to the IRA. Okay. That's where we actually have some bigger capital here. Now, what I'm going to do is I'm going to see if we're going to go to the charts. We're going to bring up the, luckily, that's bounced back. And if we go back and look at, let's say, Apple, I'm going to go ahead and right click on the chart. Okay. Now type in the chat if you use like dollar cost averaging, if you build a position. How many of you are actively in the paper money account doing that? Now, let's say we normally buy, now there's not certain like math on this. Okay. It's not like scientific. Okay. So don't think it's that. But let's say we normally put in, I don't know, $7,500. And we said, look, if I put in $7,500, that would be a full position. And if someone said, well, I just want to start to get in a little bit, let's say we break this down in thirds. Well, a third of $7,500 is going to be $2,500. Now I'm going to do this fast because we can. What I'm going to do is I'm going to set the stop underneath this low. So if we take out the low, that would be a lower low. That's a bad sign. So what I'm going to do is I'm going to take 274.34, okay, less 2%, and it's 268.85. 268.85. There it is. And I'm going to go dated GTC. Dated GTC. Okay, now the upper line above us, we got resistance at 300. Some might put a target there. But I'm going to actually go back and kind of put a target at 314. Now, you might say that's too high, but that's where we're going to put it. Okay? So this $2,500 is going to give us about 8 shares. Is this a stock and option position? Well, if it says stock, we know it's stock. Okay? Now, remember how the stop works. If it goes down to that price or less, sell the stock. What does that mean? It could fill at a lower price. Confirm send. Let's see if it fills. Sometimes it rejects me. Ah, it triggered. Now, what is probably a good idea to do? Now it fills. Now, what's probably something maybe the next step we should do? Just say with the 2,500. What's the next step? Well, that next step, what you're now going to kind of say is we should be asking ourselves, well, when might we add the next position? What would you want to see to say, now we're starting to go up. And now we're going to set the alert. Now we're going to set that buy stop. So sometimes we don't think that next step, okay? Well, let's say all of a sudden that we took out, let's say the high right there. That's 288.95. Now what I'm going to do is I'm going to right click on the chart and I'm going to go buy custom with OCO bracket. What was that? 288.80? I'm going to say 289.80. Okay, 289.80. Now this is a buy stop. Okay, this is saying buy another $2,500 worth. Okay, if the price goes up to 289.80. Now, why would you do that? Well, because that would be a short-term higher high. Does that guarantee that the stock's going to go up? No, but you're saying if it got up to that point, it wouldn't necessarily be a bad thing because that would be kind of the stock starting to fill in the gap. Now, guess what? We're going to put the target in exactly where we actually have the next ones. And so I'm kind of layering the capital. Now, this is kind of the trading plan called you show me trend, I'll show you more paper money. Now, this is kind of usually how relationships work, right? If you show me kind of more friendship, etc., I'll show you more commitment. So I'm just relating it to our normal everyday life. Now, what I'm going to do is I'm going to go confirm and send. Now, notice the target and the stop, they're $1 higher and lower. That's the default. But what I'm going to do is I'm going to come in here. Now, remember, I'm going to widen the stop down to where the previous one is, and I'm going to push up the target. And I just kind of like to kind of do this sometimes where we kind of move it up. So now what I'm going to do is kind of move it up, and on this screen, it's kind of, let me kind of resize that so we can see that. There we go. Okay. I'm going to move it right back up there. Now, if that order filled, what we could actually do is just kind of consolidate the order. The stop, do not click on the X, it'll cancel it. I'm going to move it down there. Okay. So this is for stock trades. Stock trades. Well, at least in this example it is. Okay. With other products, you could do this, but let's just say for options, it's not going to show like this, okay? For stock trades, and I'll leave it at that, okay? There's other products that you could actually do this as well, okay? So now what we actually got is that buy stop sitting right there. Now, I want to go back to one position that actually was, now I want to test you, okay? And I want to go back to this, oh my gosh, don't look. Okay, there it is. What was that candle right there? Now, hold on. I'll be right back. I'm going to go get my tape measure. Okay, I'm back. Now, what type of candle? Now, help Barbara out here. Okay, now I'm usually the chat person on her class, and she talks about candlesticks. And what type of candle is that? Okay. Yeah, I'll double check that, James L. Target for limit should be 299. Yeah, I just pushed them up, okay? So I'll go back and double check that. But I moved it up on the chart, and I will, based on what I saw, It was a limit order. The limit order on that previous does need to be GTC. True. Okay. Hammer. Now, long tail. Now, remember, when this price is going down, how do you feel? I mean, just tell me the truth. How do you feel? You're thinking, oh, dadgummit, that red candle. And all of a sudden, it's like, oh no, red candle, big body too, wide range, down from 125 to 140, volatility. And then all of a sudden, we go to the very next day, oh, red candle. Okay. Now, how many red candles do we have? Uno, dos, tres. Eins, zwei, drei. And now what you're going to kind of see is just kind of looking to see if you like volume, you're going to kind of notice there wasn't a whole lot of volume. The price was moving, but really volume was not just, well, spiking. So here's the deal. If the investor cannot handle 1 or 2 or 3 red candle days, then the investor is probably not going to be riding that many trends. Fair? Now, James, I hate it when you say comments like that. It's very bold and direct. I hate that. Now, here's the thing. I feel like I wasted so much time because I was just emotionally soft. Okay. Now, this is like in the game of sports where you're playing basketball or playing any sports and the other one just makes a nice play. The other one makes a nice shot. And then you, as the competitor, kind of have to say, okay, now I got to stay disciplined, stay focused, stay committed, and execute my plan. It was the same thing in the world of investing. Just because it goes down for 3 days doesn't necessarily mean it's over. Remember, just a couple days before, we just had a brand new high. Now, I'm going to make a t-shirt that says if we made a high, the greatest high chance, probability, is to make a potential higher low. We do not fully understand the magnitude of that comment. Okay, now, we go forward to the very next day, doink. Does that guarantee it's going to go up? No. Now, but all of a sudden, it might cause some investors to start to make maybe a trade based on that. Now, you're also going to see what type of candle is that. We said hammer, but we could also say the word engulfing. True. Very next, you actually come up to this, and here we are. Now, this is a decent move here. Now, the comments were in the chat, hey, some of this tech looks like starting to fire back to the upside. Are we maybe starting to, why is the spread so wide? Well, what causes spreads to be wide? Well, number one is lack of interest could cause the spreads on the stock to be wide. Just there's not really a lot of orders that are being placed. Now, wait, let's go to the trade tab. Let's double check. Is it maybe an issue where there's not orders? Oh, that's funny. 43 million, 44 million shares in the first 2 hours. We cannot say it's volume, okay? Now, what causes that spread on some of these to be wide? Now, that spread on Intel is about 3 cents wide. So this is probably not the one we're talking about, but the biggest thing that also can cause the spread to be wider on the stock or the option is price volatility. Price volatility, big spikes or I'd say wider price fluctuation up or down can cause the spreads to widen because it's moving so much. I mean, you got a stock in the first 2 hours moving 6.5%, among others that will show. Now, what I'm going to do here is if we go back to a 3-year weekly chart, trade number 2, if we were to look at this, we got earnings coming up on July 23rd. Now, you look at this candle on a weekly chart. We're only on Tuesday. I mean, let's just asterisk that. Trying to do a bullish engulfing so far. Maybe if we go back to the 1-year daily chart, it kind of looks like there's kind of like this flag in the shorter term, okay? Now, if we pull this back up just right there, this was the prior flag. That was kind of a longer flag. And then we kind of ran up and we kind of had a longer flag. Usually, if we're talking about kind of more of your shorter term type of flag, it's probably 8 or 10 days, okay? If we're talking more something where it made a higher low, that's more of your 1 to 3 day pullback after a 5 to 7 day upward move, which is the pull. The 1 to 3 day pullback is really kind of more like a higher low bounce setup. Now, trade number 2. We're going to come back into this. Now, I can hear the question. I feel it. It's too high. Okay, now. So I have a friend of mine, and he goes, man, before I knew you, you'd show me things like, man, these stocks are just moving. And he goes, I just never really, that was not, I would buy things that were low, not high. He goes, after years of talking to you, I actually have a newfound respect of highs. It's high for a reason. Okay. Uh, there's maybe some potential value there, a forecast of growth. There's a trend, there's some momentum. Okay. So sometimes it's maybe how we're raised that we want to buy something low priced. Some might use the word cheap. Okay. If it's higher priced, maybe there's some value there. Maybe there's also other investors watching it, buying it, holding it, and so on. Now, what we're going to do is on this trade, what we're going to do is we're going to go back to the trade tab in the IRA. We're going to say, look, is it possible? Let's go look at these options and kind of see what we're talking about. So if we look at the options, I'm still not seeing spreads really that wide. Now, here's what's kind of crazy about this. On the net change, okay, you see that right there on the right-hand side? $4, $3. Can anyone explain to me what is that telling us? $4.12. So what this is actually saying is these options at yesterday's close, they were $4.12 higher at the close yesterday. So at the close yesterday, these were like 22, okay, 77. Okay, so this is the close. This is Monday at the close. I'll put CL for the close. And then where we are now, as the price goes up on the stock price, the puts decrease in value. And now they've dropped down to, let's say, 1865. And that's what that's saying. So if someone had those sold pets from yesterday at the close, and they had the 140s, the put actually went down by $4.12-ish if they did the 140s. If they sold the 120s, the put is down $2.66, which is a decent percent. I mean, $4.12 on a $22 option, that's about a 20% return unrealized from yesterday's close to current. I don't know. Okay, not interesting you. We'll move on. Now what we're going to do is we're going to actually go look to see, is it possible to sell some puts on this? Now, if we looked at this, and we'll look at some different ones. If we sold, let's say, the 130, that's really going to be the 130 strike that has about a 34 delta. The delta between, let's say, 30 to 40. Okay? Now, if you take a look at this, what you're now going to notice is if we sell, let's say, the 130, that has really the delta of, let's say, 34. What does that 34 tell us? What does that delta of 34 tell us? The delta of 34 actually tells us the probability of the stock being below that strike at expiration, and it's also the conversion, approximately if the stock were going to go up or down $1, how much does the option move by? Stock goes up $1, the option moves by approximately 34 cents on the first dollar. Okay? Now, if we take a look at this, what I want you to notice now is by clicking on the bid, now what I'm going to show is here, we're going to click on the bid, but this is selling the put only. The con of that, the risk is all the way down to 0. If the risk is all the way down to 0, that's a lot of risk. The investor might say, look, I'm not just going to sell the 130, I'm going to buy the put below. Now, there's good and bad here, okay? You sell the put, you like the credit. You buy the put, you got to pay for it. But there could be a potential benefit to that. Now, in our normal examples, you talk about buying the put with a delta of 10 or less, something out of the money, meaning the strike is below the current stock price. But do I have to? Could I maybe do like the 8250 that are still pretty liquid? Oh, we could. But you got to remember is the wider that you put that, the more risk that you have. Does that make sense? Second, you're now going to notice is when we widen the spread on the options, the credit becomes bigger. But the biggest actually thing is you got to understand is so does the max loss. Okay? Okay? But the max loss is built in. Why? Because the investor is buying the put at 82.50. So think of this selling the put as the obligation to buy the shares. So think buy shares at 130. You buy the put, you have a right to sell. So buy shares at 130, right to sell at 82.5. The right's not free, you paid for it. Okay? Notice also the commission as well. Okay. Now, if we look at anything where there's a max loss bigger than the max profit, it tells us it's a probability type trade. Or I should say, higher probability type trade. Okay. Now, are there any questions with that? Something about James B as a time machine. Yeah, I don't have one either. I'm sorry. Okay, send. Now what I'm going to do, so trade number two. Trade number two was Intel. You're going to see that was, so trade number one was Apple stock position with the adding of the buy stop order. Trade number two was Intel. Intel was, now you might be saying, well, James, why didn't you put that on yesterday? I give the same answer. Because we do all the trades in class, we're waiting for the class to start. Okay? And so if we were on at 7:30 in the morning, could we have looked to put that position on? I think many investors might have been looking at that. Why? Well, simple answer. Because that would have been step two this morning. The moving average on the 10 period was actually green. Okay? Now, I want to kind of go to some others that are starting to kind of show a little reversal. About 10 days ago, we talked about a stock called Marvell. Okay. Now, Marvell, and there was two stocks. Let me just kind of make mention of this. On semiconductor, that's the one where the company bought another company for a couple billion. I mean, what's a couple billion? I mean, how many zeros is that? Just a couple. That was kind of, well, interesting. I'm going to keep an eye on that. They bought another company, or at least made a bid on one, and it's not gotten above the gap down high. Another stock that's kind of in that technology space that we kind of were keeping an eye on was Marvell. Now, did Marvell yesterday start to chisel out, okay, maybe a potential support area? Now, sometimes these tails give us a clue where the support and resistance levels are, okay? Tails on candlesticks. Okay, leaving footprints in the snow of where those bullish investors had or placed their orders. We can see the footprints or fingerprints on their mouses. Okay, literally. Okay, theoretically. Now, someone put in some orders in that vicinity. This is probably going to tell us where other investors might be seeing support or potential value. Now, when we get these long tails, the idea is, hey, if those investors went bearish, someone bought into that selling pressure thinking that they were support level. Today, it's price action. We see Marvell pushing back up. We back this chart off for just a second. What type of pattern do we see? This really does look like kind of a, well, and I'm going to kind of take this out to the Heikin Ashi candlestick. And the Heikin Ashi candlestick is just kind of showing us more of like a stiffer type flag. What I mean by that is kind of where there was price ascension, and then it just kind of created a sideways channel. Okay? And you can kind of say, well, where do you start from? Those are probably two angles. Okay? Now I'm going to kind of say what a friend of mine might say. Well, yeah, I'm not going to do anything until I get a breakout. Oh, for crying out loud. How many times have they said that? And then the stock breaks out. You call them back up and say, oh, you probably already in. No, yeah, I totally forgot about that one. So sometimes people kind of say stuff and they're just kind of saying stuff. Okay? So they're not really, or do you have an alert on it? Do you have a buy stop on it? I mean, is this strategy here? Are you really saying that to like execute something, or is it just kind of saying something? Now, does the investor have to go all in? Now, here's the deal. You got to think about like, well, if we're doing a stock strategy, it's the most capital intensive and it has the highest delta. Think of it as a driver in golf. Okay? The driver in golf, well, if you could connect the ball well and swing well properly, you could probably have some distance. So in my mind, when I'm thinking about stock position, I'm thinking, man, I better have some confidence, a forecast of what I think the stock could do. And the investor, right? Now, if the investor says, look, I'm going to do maybe a short put vertical, they're neutral to bullish, not as bullish as a stock investor. A cash secured put, they're thinking, look, I'm bullish. Okay, I'm more bullish than a put vertical, but I think that the price is going to be neutral to bullish. Okay. Now, if we go back and look at Marvel, let's go to the trade tab for just a sec. What type of liquidity does this have? 14 million shares. Spread on this, 30 cents wide. Maybe this is more what we're talking about. But you also got to remember is it's probably going to be the two V's, volume on the stock or the option contract, but it's probably more going to be the volatility. And if you look at many of these stocks, as I'll show you in just a second, you're going to see that the implied volatility on many of these semiconductors, they're not 15, they're not 20, 25, 30, 35. They're literally banging, okay, 80 plus. And so when that volatility is higher like that, the spreads widen out, okay, as well. So sometimes this is where kind of you say, look, I'd like to maybe do an option position. If I can or I want to, I'm probably going to have to go pick a strike where there's more liquidity and the spread's tighter. Second, maybe actually a stock position. Now, if the investors say, well, which one kind of has that volume? Well, which one actually has the most? It's the 250. That's a 55-cent wide. If we did that one, probably want to make sure we try to get that middle price, right? Now, if we said, well, what other one? It's that one right there. That one right there is not, that spread's not as tight. So that one looks like it's the tightest that I can see. Let me know if you see different. So what we're going to do is we're going to select the August 250. Okay. So the August 250 on Marvel, we're going to sell the 250 put. Now remember, if you sell the 250 put, right click, sell, let's just go single. We're going to actually go ahead and analyze that. This is really just going to show us the diagram of the strategy. Now this strategy, if we pull this up, it's going to just show us, okay, and let me actually bring it up there. Pull it up, right click, analyze. There we go. And so now what we're going to see is pull that up. Yeah, it's not. There it is. Sorry. Gotta resize it. Okay. There she is. Okay. And so the 250, that 250 strike is right there. Okay. That red line right there is the break even at expiration. Okay. That's the red line. This right there, what's that line right there? Well, let's go back. 296. If we go back to 296, 296 is right there. So what you're now going to notice is there's the current stock price. There's where the investor's saying, I'll buy the shares at the strike price from now to expiration. Here's break even. So what a lot of investors don't really understand is when they do short puts, they're really saying, I want a kind of a buffer zone where if I'm wrong, okay, how much can I be wrong by? And that's the break even at expiration. That's quite a bit. That's like $66. Okay, 296. How much is that on a percentage basis? That's quite a bit. To get to the break even. So $66 on 296, just double checking the percentages, that's 22%. So the stock could go down 22% and still be at break even. Ask your friend at work if they can have your stock go down 22% and be break even. Now that doesn't mean it's going to work, but that's interesting. This is why people sometimes like to consider selling those puts. That if that stock went down, they could still be right. If we actually look at the strike price, the 250, well, that's $46 down on a stock that's at 296. Pull it up. Well, if I said, well, if it could go down 46 to break even on a stock that's 296, it could go down 15%. Now, how's that even possible? Say the V word. Volatility. That's how. Okay. So now what we're going to do is we're going to sell the put by itself. What's the dangerous part about that?
The danger is the stock could go down to zero. Number two, the volatility could go up even higher, thus making the put more expensive to buy back. So if you sell the put, number one, you say you got some money, the investor says. And the second thing is they're actually saying, look, I don't mind to be the owner of the shares. The bad part about this is it could be assigned prior to expiration, but it does mean they get all of the premium, even though it's not at expiration. If they buy the 100 shares at 250, they then can go into the market and say, do I want to sell some of the shares, all of the shares, or none of the shares? They are their shares at that point. They can do with what they want or forecasting to do. But to sell shares or anything like that, they need to check liquidity, okay? What we're now going to do is going to go 1940, trade number 3, confirm send. Now, notice right here, we're not buying the put below. So if we're not buying a put below, the risk is there. The max loss is saying if we go all the way to zero. Notice the commission, okay? And the break even we talked about. Yeah. All right, now let's actually go back to some of the gas examples. Now, if we actually look at, let's go back to just real quick on the examples of, no, fast fire through a couple. So we talked about a couple stocks yesterday, like looking for, let's say, stocks. We talked about oil and gas, and we said is maybe gas. And by the way, this could be such an interesting discussion on gas stocks versus oil. You need oil to make the gas, okay? And that's just an interesting discussion by itself. So yesterday we talked about the movement in PSX, Valero, and MPC. You're going to notice that actually the PSX has fallen right down to the upward trending moving average. And we talked about that yesterday, okay? Now, if we brought up and said, hey, what is gas doing here this morning? Gas is, well, it's actually a little bit neutral as we speak. Crude oil, if we just look at it just real quick, slightly down. Now the PSX sitting right near the 10-period moving average. It's down $1.18 or 0.7%. If we look at Valero, which really had a big push yesterday, closed above resistance, red candle above support. You know what I'm going to say on that. You know what I'm going to say on that, don't you? What am I going to say? Right? Is the red candle above support a bad thing? Is that a setup for an entry? Okay. Now, what about MPC? We pull up MPC and say, oh my gosh, it's a red candle. It's down 32 cents. Throw in the towel, the investor says. And then the investor comes back to their own sanity and says, oh, it actually just fell down to the rising upward trending moving average. And it's down 0.1%. What I'm saying when I kind of get animated like that is when you really think out loud what your emotions internally are saying, when you say it out loud, it doesn't make a whole lot of sense. I laugh at myself. I look back, it's like, my gosh, I'm so glad I got started young. Now, I do want to, so on those gas ones, I don't think a whole lot changed from yesterday, besides the fact that we got a red candle. The red candle above the moving average and or support is the setup for the next potential go hold. Now, let me fast fire through a couple stocks, okay? Some of these stocks that we're going to kind of keep an eye on, okay? If we kind of said some stocks we're going to keep an eye on, Amazon kind of had a very volatile move just yesterday, moving average crossing over today, MACD the highest that we've actually seen in a while. LRCX, we talked about this yesterday, big actually gap up on this today and a little run. Clack, another one just real quick. That was actually kind of that follow through from yesterday. If we actually looked at something like PanW, notice that did not check back to the middle of the range. That was only like a quarter. Okay, CRWD. That one, what do you notice on CRWD? Now, when you look at these to see if they're checking back inside the previous date's range, in the first 15 to 30 minutes of the day. Okay, now look at also dog. What did you notice? In the 15 minutes in the market, I said, okay, which of these stocks are falling down to the midsection of the range? Datadog, app. I mean, these are all of them that I found in less than 10 minutes or 5 minutes. Just looking at NASDAQ stocks. There it is, right at the range. Okay. And I think WDC was the other one, which is kind of right at the middle of the range as well. So we're going to continue to follow through on this. I think the last two I'll make mention of, do not forget about AMD. We talk about ADI and AMD, AMD being stronger. And I think maybe some investors might be saying, James, is Google maybe starting to get that diagonal break? That's the other one we're going to keep an eye on as well. Okay. So did 3 examples here today, kind of rotated back to some of the gas names we talked about yesterday. Also brought up some of these names as a follow through of what we brought through of looking for stocks in the middle of the range from yesterday. Continue to keep an eye on those. We got Cameron May coming up next. I want to say thanks to Barbara Armstrong. If you like today's video, click on the like thumbs up. And also don't forget to subscribe to the Trader Talk channel on YouTube. Coming up in just a little bit after the next class, we'll have Barbara Armstrong teaching us on getting started with technical analysis as well. Thanks so much to all of you. It's been a nice session here today, a nice lively discussion, and those are the sessions we always like. And so with that said, thanks so much, and we will definitely follow through on those examples we talked about earlier yesterday throughout the week. So with that said, have a great day, and also remember that with what we discussed, it was done for example illustrative purposes. All investing involves risk. Have a great day. Take care. Bye-bye.